Walk into any trading community and you'll hear the same debate. Is futures and options trading, investing, or is it just gambling with extra steps? Welcome to Geojit Spotlight. The honest answer is F&O or futures and options can be either, and the difference has nothing to do with the instrument itself. It comes down to process. A slot machine and an options contract are both capable of transferring wealth from the impulsive to the patient. The line between them is drawn by the trader, not the market. Here's how you make sure you stay on the right side of it. Plan the trade. Don't predict the market. Every trader has done it. Scroll through the stock tip channel, read a bullish headline, and placed a trade within minutes. No extra logic, no exit plan, just conviction borrowed from someone else's opinion. That isn't trading. That's placing a bet on a tip. A planned trade starts with a thesis you can defend on paper. Why this instrument? Why the strike? Why this expiry? What invalidates this idea? If you can't articulate your entry, target and exit before you place the order, you haven't planned a trade. You have predicted an outcome. Prediction is guesswork dressed up with analysis. Planning is a process you can repeat, refine and audit. Risk management isn't optional, it's a job. New traders obsess over being right. Experienced traders obsess over being wrong safely. Before you enter F&O position, you should already know the exact rupee amount you are willing to lose. Not a vague sense of I'll get it out if it feels bad, but a defined stop loss set before emotion enters the picture. The single discipline separates professionals from speculators. A trader who risks 1 to 2% of capital per trade can be wrong 7 times out of 10 and still survive a trade another day. A trader without a stop loss can be right 9 times out of 10 and still get wiped out by the 10th. In F&O, where leverage magnifies both gains and losses, risk management isn't a nice to have, it's an entire game. Use F&O for what it is built for. It's easy to forget that derivatives weren't invented for retail speculation. F&O instruments were developed to serve 3 important purposes: hedging against price fluctuations, price discovery helping markets determine fair value, risk transfer allowing market participants to manage uncertainty more effectively. When you use options to hedge a portfolio, protect a position or express a risk-adjusted view, you are using the instrument as intended and the instrument becomes genuinely powerful. When you use it to purely multiply directional bets with borrowed leverage and no underlying exposure to manage, you have repurposed a risk management tool into a wagering tool. The instrument hasn't changed. Your relationship with it has. Emotion is the enemy of edge. Greed convinces you to hold a winning position past your target, hoping for more. Fear convinces you to exit a well-planned trade the moment it turns red, before your thesis has even had the time to play out. Revenge trading convinces you to re-enter the market immediately after a loss, chasing back what you gave up with no plan at all. None of these are trading decisions. They are emotional reactions wearing a trading account. A disciplined investor recognizes these impulses as they arise and has pre-built rules: position sizing, stop losses, a defined number of trades per day that remove the need to make decisions in the heat of the moment. The best trading systems are the ones that work even when your emotions are working against you. Treat it like a business, not a bet. Every serious business tracks its numbers, reviews its mistakes, and refines its strategy over time. Trading deserves the same rigor. That means maintaining a trade journal, measuring your win rate and risk-reward ratio, reviewing losing trades honestly instead of blaming the market, and treating each month as a cycle of iteration rather than a fresh roll of dice. A trader without a strategy is, by definition, speculating. A trader without a review process is doomed to repeat the same errors with more conviction each time. Businesses survive downturns because they learn from them. Traders should demand the same of themselves. Where you draw the line is up to you. F&O trading and gambling can look identical from the outside. Both involve risk, both involve capital, and both involve uncertainty. What separates them is invisible to an observer but obvious to the trader. A plan instead of a prediction, a defined loss instead of an open-ended one, a tool used with purpose instead of impulse, and a process that gets reviewed instead of repeated blindly. The market never decides which side of that line you are standing on. You do every time you place an order. Thanks for watching Geojit Spotlight, and do put in your comments if you have any.